or the importer, they're known as the opener because they go to a bank to open the letter of credit. The opening bank is a bank in the buyer's country. Generally, it doesn't have to be, but it will usually be in the buyer's country. And that's the bank that will actually issue the letter of credit, sometimes known as the issuing bank or the opening bank. The nominated bank is a bank in the exporter's country, and that's the bank to whom the exporter presents documents in order to get paid. They're known as they're known as the nominated bank. And the nominated bank will advise the letter of credit to the exporter. They may also confirm it. I'll explain confirmation a bit later on. And then finally, the seller or the exporter, they're known in banking terms as the beneficiary because they get the money. So those are generally going to be the parties involved. The buyer, who is the opener, the seller, who's the beneficiary, and two banks, the opening bank that issues the letter of credit, and a nominated bank in the seller's country that will advise and may also confirm the letter of credit to the seller. Those are the four parties. So how does it all work? Well, let's just run through this. So at the top, you can see you've got the four parties. From the right, you've got the exporter, the seller. Then you've got the nominated bank, the advising bank or confirming bank in the exporter's country. You've got the issuing bank in the buyer's country. And finally, you've got the buyer, the opener, the importer. So how does it all work? Well, the first thing is, of course, there's going to be a contract between seller and buyer, even before the letter of credit's been thought about. So there will be a contract between seller and buyer. And if you think to last week, that contract will have a payment clauses term in it. There'll be a clause in the contract about the payment terms, and it's at that contracting stage that agreement will be made that payment is to be by letter of credit. The next action is with the buyer. The buyer will go to a bank and open the letter of credit. So, as I mentioned earlier on, they'll probably go to their own bank, but they don't have to. They can go to any bank that would do a deal for them. And they'll go to the bank and say to them, we're buying some goods, we're buying some material from a supplier in the UK, and the value is going to be €50,000, and we want you to open a letter of credit in favour of the seller for €50,000. So they're going to go to a bank. Now the bank, they're not just going to open the LC straight away. They're going to check that the buyer is good for the money. Because remember, as soon as they open the LC, the bank has to pay the seller as long as the seller presents correct documents. So as soon as the LC is opened, the bank has a risk. And they're really going to make sure that the buyer is good for the money. If they're worried about the buyer's creditworthiness, they may say to the buyer, OK, we'll open you a letter of credit for €50,000, but before we open it, we want the money. We want the €50,000, and then we will open the LC. Or they may say, no, you're a really good customer of ours. We know you very well. You're well capitalized. We will open it and we'll debit you at the time we hand over the documents. So there'll be an agreement between the opening bank and the buyer, but the opening bank is going to make sure that they can, basically get the money from the buyer. They won't open it until they know that. And as I mentioned, if a buyer says, oh, I can't open an LC, that may well be because they're not creditworthy. It tells you a story. OK, so they go to the bank and they say, please open a letter of credit, €50,000 to pay our supplier in the UK. The bank will do the checks on the buyer, and once they're happy, they'll say to the buyer, OK, we're happy to open an LC. Please complete the application form. And the buyer will complete an application form. And basically what they're going to be doing is on that form, they will list a series of documents that the seller has to present in order to get paid. Now, if they're trained in what they're doing, if they know what they're doing, they're not just going to, pick documents at random, say, oh, I think we need bills of lading, I think we need 6 invoices. They're going to check what they really need. So the first thing they're going to do is check the import requirements of their country. So if the buyer's in India, they're going to look, what documents do I legally need, or do I need to legally import the goods into India? And they'll look at the detail. And, the detail may be India Customs, they want 6 original signed invoices. Then that will be a letter of credit requirement. There'll be, in the list of documents, it will include 6 originally signed commercial invoices. It may be they need a certificate of non-preference origin certified by a Chamber of Commerce. That will be on the letter of credit. One original certificate of origin stating the non-preference origin of the goods, certified by an authorized Chamber of Commerce. That will be on the LC. So anything that they need, any document they need to legally import the goods, they will list those documents on the letter of credit. The next thing they'll do is they'll look at the sales contract. And they'll look at what the exporter has promised to do under that contract. And they'll list a series of documents by which the exporter has to prove that they have carried out the sales contract. So, to give you a silly example, but an example that makes the point, it may be that it was agreed in the contract that all the product has to be packed in green boxes. Okay, that's in the contract. Goods to be packed in green tri-wall cartons. Then that will be on the letter of credit. Goods to be packed in green tri-wall cartons, beneficiary's certificate to this effect is required. So the LC will say the goods must be packed in green tri-wall cartons, and the beneficiary, the exporter, must provide a certificate saying that they've done so. On the sales contract, it may say goods to be shipped by containerized sea freight no later than the 1st of November 2025. That will be on the letter of credit. 3 original, 3-copy bills of lading to be presented, evidencing the goods have been shipped by container sea freight no later than, no later than the 1st of November 2025. That was agreed in the contract, so that becomes a clause on the letter of credit. In the contract, it may say that the goods must have pre-shipment inspection by Intertek Inspection Services. And it will go on to, and so that will be on the letter of credit. That will be on the LC. The LC will say something like, pre-shipment inspection to be conducted by Intertek Inspection Services, clean certificate of inspection stating the goods are as per this contract must be presented. And that means before shipment, the goods must have an inspection. The inspection company must issue an inspection certificate, and that certificate must state that the goods meet the requirements of the sales contract. So there'll be a whole list of documents, and what you can probably see is by listing those documents, the buyer, the importer, in India, they can be sure they're going to get documents that they need to meet the legal import requirements in India. That's the first thing. And secondly, they're going to ask for documents to prove that the seller has performed the sales contract. So all of that will be listed on the letter of credit. So the buyer will complete the application form and they'll send the application form to the opening bank. The opening bank will then open the letter of credit based on the requirements stipulated by the buyer. The opening bank will then send that letter of credit to the nominated bank in the UK. So the bank in India that opened the LC will send the letter of credit to a bank in the UK with whom they have a relationship. And that bank in the UK will check the signatures, the electronic signatures on the LC to make sure to make sure it's a legal letter of credit. Having done that, the nominated bank in the UK will send the letter of credit to the exporter. So the exporter in the UK, they get the letter of credit, And really, really important, they examine it very, very carefully to make sure they can comply with the documentary conditions. Because remember, if there's even the smallest thing they can't comply with, they're not going to get paid. So before they ship the goods, they're going to check it forensically to make sure they can comply. And I always recommend in companies they have two people trained to do this, so that one person checks the LC, finds everything's okay, then they give it to someone else to double check. It's a good thing to do because there may be small stipulations that really matter, but it's easy to miss. So I always say in companies, do a double check of the LC before you ship the goods. If there's anything they can't comply with, then they would ask the buyer to issue an amendment. So for example, they get the LC. So, okay, for example, the letter of credit says goods to be shipped no later than, gosh, I'll get this right in a minute. Let me start again. The contract between the seller and buyer says goods to be shipped no later than the 1st of November 2025. That's agreed in the contract. The exporter gets the LC and they look at it and says goods to be shipped no later than the 1st of October 2025. And the seller may say, we can't do that. We can't get the metal ready in time. It won't be ready. And it's not what was agreed in the contract. So the seller would contact the buyer and say, we think you've made a mistake in the LC conditions. You've put goods to be shipped no later than the 1st of October. The agreement in our contract was the 1st of November. So please issue an amendment to the LC, changing 1st of October to 1st of November. The buyer in India would say, really sorry, our mistake on the application form. We will instruct the issuing bank to issue an amendment. So the buyer will instruct the issuing bank to change the clause saying 1st of October as latest shipment to 1st of November. The issuing bank will send the amendment to the nominated bank in the UK, and the nominated bank will send the amendment to the exporter. So the golden rule for the exporter is that you don't ship the goods until you've got a letter of credit that you can comply with. If you have to wait for amendments, you wait for amendments before you ship the goods. So the exporter, they've got an LC, with or without amendments. If they need amendments, they've waited for the amendment, and now they've got an LC that they can comply with. They are then safe to ship the goods. So they dispatch the goods to the buyer, to the importer. The next thing they do is they have to get all the documents together called for in the letter of credit. And they've got to make sure that the documents match the wording on the letter of credit. It's not hard, but there's no grey areas. Whatever the wording is on the LC, that wording is transferred to the documents generated by the seller. So the seller gets all the documents together required by the LC, and they check the documents against the letter of credit to make sure the documents comply. And again, I always say to companies, have a double check. Get two people to check the documents against the LC to make sure the documents are compliant. Having ensured the documents are compliant, the exporter then presents the documents to the nominated bank in the UK. The nominated bank in the UK will check the documents against the letter of credit forensically. If the documents comply, the bank in the UK will pay the exporter, or if it's a term payment, they'll payment straight away if it's a site payment. If it's a term payment, in other words, if the exporter's given credit, then they will write to the exporter and say, we've received your documents, we undertake to pay you on the maturity date, and they'll tell them the maturity date for payment. The nominated bank in the UK will then forward the documents to the opening bank in India. The opening bank in India will again check the documents forensically against the LC. And as long as they're happy with the documents, they'll release the documents to the buyer in India and debit their account if they haven't already done so. The buyer then uses those documents to take delivery of the goods. So the buyer ends up with the goods, the seller ends up with the payment. And as you can see from that, the letter of credit has protected both the buyer and the seller. If the seller can't present the documents listed, they won't get paid. Okay, simple as that. Things can be done to correct that, but we'll talk about that later on. But in effect, if they can't present documents to prove they've carried out the contract and the documents the buyer needs, then quite rightly they won't get paid. If they can prove that by presenting compliant documents, their payment is guaranteed. So, as I say, we've ended up with a payment method protecting both seller and buyer. Okay, any questions on the process? Okay, so a few moments on the different types of LC. I guess the big takeaway here is confirmed and unconfirmed. And the only difference between a confirmed LC and unconfirmed is that with a confirmed LC, if we just go back to the diagram, if, for example, the seller presented correct documents to the nominated bank in the UK, but the opening bank went out of business, okay, and couldn't pay the money to the nominated bank, with a confirmed LC, the nominated bank in the UK would still pay the seller, even though they would know they won't be able to get the money from the opening bank. So the takeaway from that is that if there's deemed to be a high banking risk, if you're selling to a high risk country, you would always want a confirmed letter of credit in case the opening bank fails. But if you're selling to a low risk country, unconfirmed is absolutely fine. There's no problem with it at all. So, for example, if you're a European exporter, if you're selling to the UK, to Canada, to Australia, to most countries in the Middle East, to a lot of countries, to Singapore, to Japan, an unconfirmed LC is fine. And with bank charges, it will be cheaper than a confirmed. But if you're selling to a high risk country like Nigeria, Venezuela, Cambodia, interesting markets, but high risk, you would always want a confirmed LC. So low risk countries, unconfirmed is fine. High risk countries, you would want a confirmed LC. Under the current rules, all letters of credit are deemed to be irrevocable even if they don't say so. And that's good. It means the LC can't be cancelled, it can't be changed, it can't be amended unless both the seller and the buyer agree. So that's good. That's a protection for both parties. LCs are irrevocable even if they don't say so. A revolving letter of credit, that would be a situation where, for example, seller and buyer, they have a 12-month contract to provide the same quantity of materials once a month for 12 months. The same type of material, the same quantity, the same price, once a month for 12 months. And what they could do is they could open a new letter of credit every month. But with a revolving letter of credit, you don't have to do that. With a revolving LC, the seller would ship the goods out for the first month, present documents and get paid, and then the LC would automatically reinstate itself for the second month, when the seller would ship the goods, present the documents and get paid, and then for the third month until the LC expired at the end of the contract period. So that's what a revolving LC is. It simply avoids the need of the buyer to open a new letter of credit every month with something like a 12-month contract. And then we have transferable and back-to-back, typically used by traders. You're buying material in, you're buying minerals in from one party and you're selling them to another party. Okay, so if the party that you're selling to opens the LC as a transferable LC, that means you can transfer part of the proceeds to your supplier. So that can be a very, very good trading tool. You're buying the material for $5,000 and you're selling it for $10,000. So your customer opens the LC for $10,000, $5,000 is transferable to your supplier. Back-to-back LC, it's the same, has the same effect, but it works in a different way. With the back-to-back LC, what actually happens is you get the LC in the normal way from the nominated bank. So you get the standard letter of credit in the normal way, and then you say to the nominated bank, okay, I've got an LC here for 10,000, what did I say, dollars, $10,000 from a buyer in India. I've got to pay a supplier in Zambia $5,000. And using this LC for 10,000, I want you to use this as collateral to open another LC by which I will pay my supplier in Zambia. And that's a back-to-back letter of credit. Because the first letter of credit by which the exporter gets paid from India is used as collateral to back the opening of a second letter of credit to pay the supplier in Zambia. It's a really good financing tool. A standby letter of credit, that's really, it's a credit control tool. And the idea of a standby letter of credit is exactly as it sounds. So if you're trading under open account, you've done your checks, it's a low risk situation. And you decide, okay, low risk country and low commercial risk, we're going to trade with that customer under open account. So you trade with them for a while under open account, they pay you on time, and then you see their payments are getting slower and slower and slower, and you start to worry. They've stopped paying you on time, and you think they may have a problem. So what you can say to them is, okay, you can carry on paying us under open account, but we want you to open a standby letter of credit. And if you fail in a payment, we will use the standby to get paid. So if you then continue trading with them, if they start paying you on time under open account, then you would never use the standby. But if they fail in a payment, you can then get the standby LC out of the drawer and you can use that to get payment. There are special rules for standby LCs, and those rules are called ISP 98, International Standby Practice 98. That's what ISP 98 is. And finally, there are red clause and green clause letters of credit. And with those, they enable the exporter to get a deposit before they ship the goods. So it's a way of getting pre-shipment payment. And typically, you would get a letter of credit in the normal way from the nominated bank. And in a clause traditionally, which would be in red, it may say 10% of this LC value may be claimed immediately. 90% will be payable in the normal way against presentation of documents. So it's purely a way of getting a deposit on the goods if a deposit has been agreed in the contract of sale. That's what a red clause or a green clause is. So those are the main different types of LC. Any questions on any of those? Okay, so the key takeaway there is the most common one, unconfirmed or confirmed. And remember the key takeaway, if you're an exporter selling to a high risk country, you would always want a confirmed LC. If you're selling to a low risk country, unconfirmed is absolutely fine. If you're worried, if you're concerned about whether a country is high risk or low risk, talk to your bank. They have indicators and they would say to you, absolutely, that's low risk, unconfirmed is fine. Or they may say to you, no, trading with that country, you need a confirmed LC. They can guide you. Okay. So with a system, an international system like a letter of credit, there's got to be rules. And with LCs, we have three sets of rules. The main rules are called Uniform Customs and Practice for Documentary Credits. And that's International Chamber of Commerce Publication 600. And we normally abbreviate that to UCP 600. So if anyone says to you UCP 600, those are the set of rules under which all letters of credit will be opened. When you get a letter of credit, it's something to look out for, and it will always be there. It will always say subject to UCP 600. And then those rules will apply. Not used very much yet, that if you present electronic documents instead of paper documents, and frankly, the world isn't yet ready for that, but there are a set of rules covering that, and those rules are called the EUCP rules, E for electronic presentation. Now, those rules have been around for about 15 years. They've only been used about 3 times globally. So we're not ready for that yet, but we do have a set of rules for the time when it does become normal to present electronic documents. Expectations, we're quite a way away from that at the moment, but the time will come at some stage. And then finally, we have ISBP, or International Standard Banking Practice. And ISBP, they provide the interpretation for the UCP 600 rules. So essentially, we have 3 sets of rules, but the main rules are UCP 600. And the concept of the rules is there must be no grey areas when you deal with a letter of credit. It's all about, do the documents presented by the exporter, do they comply or do they not comply? If they comply, the exporter gets paid. If they don't comply, the exporter doesn't get paid. So the main thrust of the rules is really this whole point. Has the exporter complied with the LC or not? And we can't have grey areas. Okay, so we need to have a very, very prescriptive set of rules. And, we'll look at some of the rules. We haven't got time to go through the whole thing, but we'll look at some of the rules and you can see just how prescriptive the rules are. And I'm going to give you some examples. So, for example, we have a definition. Article 2 is all about definitions. And, it will say things like, if you see the word applicant on an LC, what does that mean? And it will tell you the applicant is the opener of the letter of credit. In other words, the buyer, because they apply for the LC. Now, it's very common now on a letter of credit that you'll be told that you as the exporter will be told to do something within a number of banking days. For example, the LC may say documents to be presented to the nominated bank within 7 banking days of shipment. Okay, that means you've got to present the documents to the bank, to the nominated bank, within 7 days of shipment, 7 banking days. So it's telling you to do it within 7 banking days. So the next question is, what is a banking day? We need to have a definition. Because, of course, a banking day in the UK is going to be Monday to Friday. A banking day in Abu Dhabi is going to be Sunday to Thursday. So we need to be clear. And it gives us a definition. It will say a banking day is a day on which the bank is usually open in the country where the activity is to take place. So we have a clear definition of what is required of a banking day. I'm not going to go through all of this in detail because it doesn't matter. I just really want to get you a feel for it. A complying presentation. What is a complying presentation of documents? And it will stipulate that a complying presentation of documents by the exporter is a presentation of documents that meet all the terms and all the conditions of the letter of credit. And it goes on to state, if it is a complying presentation, the bank must pay the exporter. And then we have definitions of some of these strange words: honour, negotiate, and paying. And that's all about when will the exporter get paid? And what is the role of the nominated bank? So it would tell us that, for example, if the nominated bank in the exporter's country is negotiating the letter of credit, that means they will use their own funds to pay the exporter. If they're called the paying bank, that means they'll wait till they get the money from the issuing bank. So the only difference there is that when the exporter receives the LC, if it says payable by negotiation, it means they'll get payment generally within about 24, 48 hours of the bank accepting the documents. If it's the paying bank, they've got to wait till they get the money from the issuing bank, and that could delay the payment by about 24 hours. So there's not very much in it, but it just makes it clear when payment's going to be made. It also states that the issuing bank must honour the LC. a very clear instruction from the opening bank. As long as the documents are correct, they have to pay. They cannot dishonour the LC. You can't have a situation where the buyer says to the bank, oh, don't pay, because the bank will say, we have to. The documents are correct. By law, we have to make the payment. Okay. So then we have Article 3, which is all about interpretation. And, there are some weird things there, but there's a reason for all of them. Look at the first one there. Words in the singular include the plural and the other way around. And the reason they put that in, the rules, is because most letters of credit are issued in English. Now, there's no law that says they have to be. But globally, we're seeing that virtually every letter of credit is issued in English. And in English, if it's not your first language, plurals can be very, very confusing. Is there an S on the end of a word or isn't there? That can be really confusing. And in the past, some banks have rejected documents if there's been an S on the end of the word when there shouldn't be, or if there isn't an S on the end of a word when there should be. So to get over that, under Article 3, it says words in the singular include the plural and the other way round. So, if there isn't an S, if there is an S, it doesn't matter. It's not a discrepancy. Credits are irrevocable, even if unstated. That means that they can't be changed, cancelled, or amended unless both parties agree. That's a good thing. Branches of the same bank in different countries are considered separate banks. So if the LC is opened by HSBC India and it's advised by HSBC UK, they would be treated as separate banks. That's a legal protection, okay? So that if one bank fails, the other bank is deemed not to have failed. So, it's not that important, to be honest, but it is a good legal protection. Then you receive the letter of credit and you're told to carry out an action promptly, immediately, as soon as possible. So documents to be presented immediately after shipment or as soon as possible after shipment. If those words are on the letter of credit, you can completely ignore them because no one knows what they mean. There is no definition for prompt, immediately, as soon as possible. Does it mean within an hour, a minute, a day, a month, a week? No one knows. So that's guidance for the opener, for the buyer, when they open an LC. Don't put vague wording in there. Documents to be presented promptly after shipment or immediately after shipment. Be absolutely prescriptive. Documents to be presented within 5 days of shipment or within 10 days. Be clear in what you want. Don't use vague terminology, because if you do use vague terminology, for example, promptly, immediately, as soon as possible, the exporter can completely ignore that requirement. Some documents may have to be signed. So that may sound very, very straightforward. But we need to have a definition of what is a signature. And the rules really do go into that much detail. So it's very, very clear under Article 3. If you have to present a signed document, you can sign it by handwriting, facsimile signature, perforated signature, stamp, symbol, or mechanical or electronic method of authentication. Any one of those means will do as a signature, will be acceptable by the bank. It doesn't have to be a written, wet signature. You can use a rubber stamp. If you've got a rubber stamp with your signature on, that will do as a signature. So we have clarity on that. If you're asked to provide a certified or legalized document, unless the LC is more specific, then a requirement for certification or legalization is satisfied by any signature, mark, stamp, or label. Okay, so again, it's really instructing the opener when they open the LC. If you want, for example, a certificate of origin to be certified by a Chamber of Commerce, then you must state that. Original certificate of origin certified by an authorized Chamber of Commerce. If you don't state that, if you just ask for a certified certificate of origin, but don't state who must issue it, then that requirement will be satisfied by any signature, mark, stamp, or label. Now, Article 5 is core. It's really the key article in how LCs work. And what Article 5 says is that banks deal with documents and not with the goods, services, or performances to which the documents may relate. So when the bank is checking the documents to decide if they can pay the exporter, all the bank is allowed to do is check the documents against the letter of credit. If the documents comply with the letter of credit, they have to pay the exporter. What the bank is not allowed to do is question the documents. They're not allowed to do that. So, for example, if the LC says goods to be shipped by the 1st of October 2025, the bill of lading is dated the 1st of October 2025, so they've complied with that. The bank is not allowed to say, I don't think that ship sailed on the 1st. I think it sailed on the 2nd. They're not allowed to do that. If the LC calls for a certificate of origin stating the goods are of UK origin, and the exporter issues a certificate of origin stating the goods are of UK origin, the bank is not allowed to say, I don't think the goods are of UK origin. I think that copper came from Zambia. They're not allowed to do that. All they're allowed to do is check the documents against the wording of the LC. So Article 5 is core in the way LCs work. The banks are only allowed to deal with documents. They have no right and no requirement to deal with the goods, services, or performances to which the documents may relate, because they can't. Article 3 is all about availability. There's some detail there. Don't worry too much about that. But the key point there is the 4th bullet point you can see there. Letters of credit are always available with the issuing bank. So the exporter, if they want, can cut out the nominated bank and they can always send the documents directly to the opening bank. They're allowed to do that. But I always say to exporters, don't do it. Always use the nominated bank, because that way, if there's a problem with the documents, you can get them back and you can correct them and represent them. But if the documents are already in India, then there's going to be a big delay and the LC may expire in the meantime. But it is one of the rules that LCs are always available with the issuing bank, and that means if exporters want, they can always present documents directly with the issuing bank. But I stress that is not a good thing to do. The responsibility of the nominated bank, that's in Articles 9 and 10. Under the current rules, it's a new article, and it includes all the details about amendments and things like that. And it also tells the nominated bank that they must satisfy themselves that the letter of credit is authentic before they send it to the exporter. It's not very prevalent now, but in past years, there really have been issues with fraudulent letters of credit. Nowadays, it's fairly rare. 20-25 years ago, there were quite a lot of them floating around. So because of that, there is a requirement. The nominated bank, they must make sure that the letter of credit is authentic before they send it to the exporter. Article 14 is all about the standard for examination of documents. It's what the bank must check when they're deciding whether to pay the exporter or not. And a lot of that is implemented via international standard banking practice. We'll have a brief look at that in a few minutes. The key takeaway for this is that the banks are only allowed 5 banking days to check the documents. And that means that when the exporter presents documents to the nominated bank, they have 5 banking days to say to the exporter, yeah, the documents are fine, we're going to pay you, or no, we can't pay you because there are discrepancies. And they have to give that within 5 banking days. And the rule is very, very clear. If the bank doesn't advise the exporter within 5 banking days, then the bank has to pay the exporter. So that's very, very clear. The banks are allowed 5 banking days to check the documents for compliance. The key point here is actually the middle bullet point. The biggest reason why banks reject documents is where documents are not consistent with each other. So, for example, the LC, just to give you an example, maybe the LC is silent about the origin of the goods. It says nothing about the origin of the goods. But it does call for a certificate of origin, and it does call for a commercial invoice. And on the commercial invoice, it shows the origin as UK. On the certificate of origin, it shows the origin as USA. That's an inconsistency. They can't both be right. So that's a really important point, because inconsistency is the biggest reason why banks reject documents, where there are two documents presented and they have conflicting information on those documents. In that case, the inconsistency rule will be applied, and that will be a discrepancy. So that's really important. As you can see there, there's also a general requirement that a document presented must appear to fulfill the function of the document. So if the letter of credit calls for a weight note, the document presented must appear to fulfill the function of a weight note. If the LC calls for a clean certificate of inspection, the document presented must appear to fulfill the function of a clean certificate of inspection. The third bullet point there is interesting. For years, there was an argument about whether banks should accept transport documents issued by freight forwarders on behalf of carriers, or only accept documents issued by carriers. There were big arguments about that. So in the current rules, they've made it very, very clear. The issuer of a transport document, like a bill of lading, an airway bill, a road consignment note, the issuer of a transport document requirement does allow MVOCC and freight forwarders documents. In other words, they don't have to be issued by the carrier. They may be issued by a freight forwarder on behalf of the carrier. Article 15 is a new article in the current rules, and it's all about what the nominated bank must do once they've determined that the presentation of documents complies with the letter of credit. I mean, the banks know what they've got to do, but it's now enshrined in the rules. So you present documents to the nominated bank, and it's very, very clear. The nominated bank checks the documents. They find out they're compliant. It's very, very clear they must honour or negotiate. In other words, they must pay the exporter. It's also very clear they must then forward the documents to the opening bank. Now, they know they've got to do that, but as I say, it's now enshrined in the rules. Article 16 is all about discrepant documents. The banks can't just say to you, we're not going to pay you because the documents are discrepant. They've got to give a proper refusal notice pointing out what the discrepancies are, so that hopefully you can correct them. So Article 16 is again for the nominated bank, and it tells them if you're refusing a presentation of documents because of discrepancies, you've got to be very, very clear what the discrepancies are, so that hopefully the exporter can correct the documents and re-present them. Because remember, the exporter owns the documents until they've been paid. So even though they've been presented to the nominated bank, until payment's been agreed, those documents are owned by the exporter, which is a good protection for the exporter. Now, some documents will have to be presented in original, other documents in copy. So we need to have an interpretation. What is an original document? It sounds very straightforward, but we need to have a clear interpretation. Article 17 gives us just that. It gives us the interpretation. And it will tell us that a document will be treated as an original if it meets any one of these requirements. Firstly, if it's got an original signature, it will be deemed to be an original document. Or if it's got the word original on it and it doesn't appear to be a copy, it would deem to be an original document. If it's handwritten, it will be deemed to be an original document. If it's on the issuer's note paper, if it's on their official note paper, even if it's not signed, even if it's not marked as original, if it's on original note paper, it will be deemed to be original. And finally, if any of you at all still have a typewriter, if you do still have a typewriter, you win a prize, but it will tell you that the top typed copy will be deemed to be an original. So any one of those things will constitute an original document. It goes on to say that even if the letter of credit doesn't call for it, at least one original of each document must be presented. So, for example, if the LC says 5 packing lists, at least one of those packing lists must be an original. It's easy to do. You just write the word original on one of them or 2 of them. It doesn't matter. If the LC calls for copy documents, you can always present originals instead of copies, but you can't present copies instead of originals. That stands to reason. So we have a very, very clear definition of what constitutes an original document. Then commercial invoices. You know, LCs can call for a bundle of different documents, but the document which will always be required will be the commercial invoice. And the key point there is the second bullet point. Every letter of credit will give a brief description of the goods as agreed in the sales contract. It won't give a whole long description. There'll be a brief description. But the description of the goods on the letter of credit must be exactly the same on the commercial invoice, because that's the legal proof that the exporter has shipped the correct goods. It's easy to do. You know, the exporter, when they're preparing their invoices, they just copy the description on the LC onto their invoices. Then they know they're giving a correct description. But it's a really important point that the description of the goods on the commercial invoice must be exactly the same description as on the letter of credit. We then have a bundle of articles all about the different kinds of transport documents and how they must be generated, how they must be presented. So if it's multimodal shipping, for example, a door-to-door container shipment, Article 19 gives the instructions on what that document must look like. If it's a port-to-port bill of lading or non-negotiable way bill, then Articles 20 and 21 apply. And they include things like the name of the captain of the ship doesn't have to be shown, it's not important, but there must be conditions of carriage. Think back to yesterday. So the conditions of carriage must be on the transport document. If they're not on the transport document, then the transport document must give a website from which the conditions of carriage can be extracted. So Articles 20 and 21 are all about the content of bills of lading and non-negotiable way bills. Article 22 is interesting. Charter party bills of lading. So if the seller has chartered a ship to ship the goods to the buyer, and one of the documents that has to be presented is a charter party bill of lading, the banks will not examine the detail of the charter party bill of lading. All the banks will do is make sure it's there. Okay, and that's simply because charter party bills of lading, they're complicated. You can't expect the banks to understand them. So if the LC calls for a charter party bill of lading, all the bank will do is make sure it's there. They'll make sure it's been presented, but they won't check the detail. Article 23 is all about airway bills, what's expected if an airway bill has to be presented. Article 24 is all about road, rail or inland waterway documents. Article 25 is all about courier receipts. And Article 26 is about on-deck shipment. So let's think about steel. There's an issue here, because Article 26 is very clear. If a bill of lading says the goods have been shipped on deck, that would be a discrepancy. The banks will not accept a bill of lading saying the goods are shipped on deck. The reason for that is if the goods are on the deck of the ship, they are deemed to be vulnerable. Now, the problem you've got when you deal with commodities, that very often with commodities like steel, they will actually be loaded on deck. So in that case, when the buyer opens the LC, they have to expressly modify Article 26. And what they would have to do when they open the LC is they would have to override it and put a clause in saying, notwithstanding Article 26 of UCP 600, we will accept bills of lading stating the goods have been shipped on deck. We will accept that. Then you've got over that problem. Similarly, with clean transport documents, when the shipping lines or any carrier, when they receive goods for transport, they will always check the condition as far as they can. And if they think on receipt there's something wrong with the condition of the goods, they will put a clause on the bill of lading. Maybe something like the goods appear to be damaged, or the goods appear to have insufficient packaging, and that protects the shipping line. And that would be called a claused bill of lading. If the bill of lading is claused, the bank will not accept it. The bank will only accept clean transport documents. And again, you can have a problem. For example, something like steel. The problem with steel is it always goes rusty when it gets near the sea. So again, this is a situation when the buyer opens the LC, they have to issue a caveat, notwithstanding Article 27, we will accept a bill of lading stating that the steel is rusty. Rust on the steel will be acceptable to us. So that's how you get over something like that. Article 28 covers the insurance document, remembering that if it's a CIP or CIF transaction, there will be a requirement to present the insurance document, only if it's a CIP or CIF transaction. So Article 28 gives the rules for insurance documents. It says that policies can be presented instead of insurance certificates. And it also says any exclusion clauses will be acceptable, which is, a little bit strange, but that's what the rules say. As long as the insurance document is there, even if there are loads of exclusions on it, the bank will accept it. So any exclusions will be acceptable. Article 23 is hours of presentation, and it basically says that banks are only obliged to accept documents received within their normal banking hours. So, for example, in the UK, normal banking hours are 9:30 to 3:30, and that means the banks are not obliged to accept documents in the UK after 3:30. Probably they would accept them, but they're not obliged to do so. Article 36 is about force majeure. There we go. We then have EUCP, as I'd mentioned, not used very often, in fact, only used a few times in the last 15 years. But when the world of international trade does go digital, EUCP gives the rules for electronic presentations, electronic documents. There's only 10 articles in it, and it covers things like what constitutes an original document if it's an electronic document, or what constitutes a signature on an electronic document. So that's EUCP. I wouldn't worry too much about that now. We're not ready for that yet, unfortunately, but in the years to come, EUCP will become increasingly important. We then have international standard banking practice. International standard banking practice gives the interpretation for the UCP rules. And we have an introduction to ISBP, and basically in the introduction it tells us that the practices described in this publication highlight how the articles of UCP are to be interpreted and applied, to the extent that the terms and conditions of the letter of credit or any amendments thereto do not expressly modify or exclude any applicable article. So, it's a bit strange wording, but it's basically saying, okay, UCP 600, the wording is very, very legal wording. So in this publication, we're giving the interpretations. And they don't hold back. So in the scope, it's under ISBP, it states many of the problems that arise at the document examination stage, in other words, when the bank checks the documents, many of the problems could avoided or resolved by the respective parties through careful attention to detail in the letter of credit or in any amendments to them. And it goes on to say the applicant and the beneficiary, in other words, the buyer and the seller, should carefully consider the documents required for presentation, by whom they're to be issued, their data content, and the time frame in which they're to be presented. In other words, when the exporter gets the LC, for every document the exporter must present, it must be very, very clear from the letter of credit by whom that document must be issued, the data content of the document, and the time frame in which it must be presented. No grey areas. It must be very, very clear to the exporter what they have to do in relation to that document. In part 7 of the scope, it also makes it very clear, and this is pretty important, that a letter of credit should never require presentation of a document that has to be issued, signed, or countersigned by the buyer. If there is such a requirement, the beneficiary should consider the appropriateness of such a requirement and determine its ability to comply with it or seek a suitable amendment. Now, that's very important because one of the principles of letters of credit is that the documents should be within the control of the exporter. And if there's a requirement on the letter of credit that the exporter must present a document which is provided by the buyer, if the buyer doesn't give that document to the exporter can't get paid. Or if they delay in giving that document to the exporter can't get paid. So there should never be a requirement, for example, there should never be a requirement that the exporter, the seller, must present an acceptance certificate issued by the buyer, because that means the seller's going to have to wait till the goods arrive, typically under a D Incoterm. They're going to have to wait till the goods arrive and then trust the buyer to issue an acceptance certificate and send it back to them so that they can present it to the bank to get paid. So that's why I think you may remember from last week, you can't use a D Incoterm with a letter of credit. It doesn't work. Okay, so key takeaway there from a seller's point of view is never accept a requirement where you have to present a document which has to be provided by, signed or countersigned by the buyer. ISBP gets updated very regularly. Whenever there's a query, for example, the seller presents documents to a bank, the bank says we can't pay you, there are discrepancies, the seller doesn't agree there are discrepancies, the ICC may be asked for a decision. And those decisions become part of international standby practice. Because of that, ISBP is updated fairly regularly. The last update was in 2023, and you can see there that there are some really detailed updates in standard banking practice. Because of time, I'm not going to go through all of them, but just to look at a couple of them, it gives you an example of the level of detail. So, for example, it says the abbreviation IND can be used instead of the word industries. So if the LC has the word industries and the exporter doesn't put industries, they put IND on the document, that's absolutely acceptable. There's nothing wrong with that. That's a decision that they've made. If you look a bit further down, copies of documents don't have to be signed. They've made it absolutely clear in ISBP, if it's a copy document, it does not need a signature. Then, if we go a bit further, an invoice presented under a letter of credit issued is, let me start again. An invoice presented under a letter of credit issued in US dollars, bearing only the dollar sign. It doesn't say US, it just has the dollar sign without any further qualification. Fulfills the requirement of UCP 600 subarticle 18A3 unless data in the invoice itself or another presented document implies that the dollar sign may refer to a currency other than dollars. So again, it's a bit long-winded, but it's very, very clear there that unless the LC says something different, if the US dollar symbol is used, but it doesn't say the word US, it doesn't matter. It will be deemed to be US dollars. So again, I think you can see here that ISBP, it stays up to date and it really does go into a lot of detail. And it gives some general principles. Generally accepted abbreviations may be used on documents. For example, CO instead of company, INTL instead of international, as we've seen, IND instead of industries. So generally accepted abbreviations are fully acceptable on documents presented. Certificates must be signed. And you've got some other detail there. Again, because of time, I'm not going to go through a huge amount of detail. Third bullet point there is quite interesting, isn't it? The fact that a document has a box in it, a field or a space for data to be inserted doesn't necessarily mean that completion is essential. So if you look, for example, at a bill of lading has a lot of boxes on them, a lot of spaces, a lot of fields, but you don't fill every box in, every field in for every shipment. The bill of lading will have a space for final delivery point, but if it's not a door-to-door delivery, then that box won't be completed. So just because a document has a field in it, or a space, or a box, it doesn't necessarily mean something has got to be in there. Again, you can see how much detail there is there. Where a letter of credit requires a document to be issued by a named person or a named entity, the condition is satisfied where the document appears is the important word, where the document appears to be issued by the named person or entity by use of its letterhead, or where there is no letterhead when the document appears to have been completed or signed by the named person or entity. So in that principle, the important word is appeared. If there's a signature on it, the bank has no idea who signed the document. They've got no idea. So as long as it appears to have been issued or signed by the person stipulated in the LC, the bank will accept it. Third bullet point here is quite interesting. Where the presented documents indicate mathematical calculations, banks only determine that stated totals do not conflict with the credit or any other document. In other words, the banks are not allowed to check your mathematical calculations. All they're allowed to do, for example, if there's 10 different kinds of metal on the invoice, the shipment is 10 different kinds of metal, and you've got each type of metal as a separate line on the invoice, the bank is not allowed to check your mathematics in the adding up. All they're allowed to do is check the totals, agree with the letter of credit, or do not conflict with the LC. They're not allowed to check your mathematic calculations. And again, the first bullet point here is, I spoke about this earlier on, there's a myth that if the exporter makes a mistake in a document, they won't get paid. If they make a spelling mistake, they won't get paid. And it's very, very clear in the rules. A misspelling or a typing error that does not affect the meaning of a word or the sentence in which it occurs does not make a document discrepant. For example, the goods are machines. But on a document, it says M-A-S-H-I-N-E. It should have been M-A-C-H-I-N-E. Okay, it's clearly a spelling mistake. Someone's put an S in there. It should have been a C. That is not a discrepancy. It's clearly a spelling mistake. The bank is not allowed to reject the document because of that. However, if the goods description was model 123, it was model 321, and the document said model 123, that is clearly a discrepancy because it's a conflict in data. It could be something completely different. And the other point there is interesting as well. Whenever you're asked to do something on a letter of credit, it should always ask for a document to prove it. If it doesn't ask for a document to prove it, it's a non-documentary condition, and the exporter can ignore it. So, for example, the contract says all the goods must be packed in green boxes. That's agreed in the contract. When the exporter gets the LC, The LC will probably say, all the goods under this contract must be packed in green boxes and a certificate to this effect is required. And the exporter presents a certificate. We hereby certify we've packed the goods in green boxes. They've certified they've done it. However, if the LC doesn't call for a certificate, if it only says goods to be packed in green boxes, full stop, it doesn't ask for a document, it's a non-documentary condition, and the exporter can completely ignore that condition because it's non-documentary. And the whole concept of a letter of credit is that it's all about documents. It's about documents proving the exporter has done what they're contractually required to do. And as you can see, quite a lot of detail there. Signatures don't have to be handwritten. Documents can be titled as called for in the letter of credit. They can have a similar title or they can be untitled. So if you're asked to present a packing list, my recommendation is call the document a packing list. Then there's no question about it. However, if you call it a packing note or you don't call it anything, but it appears to be a packing list, the bank has to accept it. But my guidance there is if they ask for a packing list, call it a packing list, and then the bank won't query it. And we get clauses covering all the different kinds of documents you may be asked to present. So ISBP, International Standard Banking Practice, it gives a huge amount of detail on the requirements of UCP 600, essentially on the requirements of different documents that you may be required to present. Okay, let me pause there. We've done a quick run through there. Any questions on the rules? Okay, so just a few things on good practice. If you're the exporter, you can leave it to your customer to open the letter of credit, and they can, check on the documents required. They can do their checks and open it. But it's good practice to guide the customer. If they're not used to opening LCs, work with them, because once they've opened the letter of credit with the bank, if anything needs changing, you've got to get an official amendment, and then it starts costing money. It's much, much better to work with the buyer, work with the opener on agreeing the documents required to be presented. That's always a good thing to do. Remember, as an exporter, always check the LC on receipt before you ship the goods. Always make sure you can comply. If there's anything you can't comply with, you ask for an amendment to the LC. You don't ship the goods until you receive the amendment in your office. That's important. And also remember, before you ship the goods, before you present the documents to the nominated bank, do a forensic check of the documents to make sure they comply with the wording, the terms and conditions of the letter of credit. So from the exporter's point of view, we have prescriptive rules for handling compliant presentations. There's been a reduction in the timescale that banks are allowed to check the documents. So that's pretty good for the exporter. It's quite a liberal regime from the exporter's perspective. If you think back, a signature, what constitutes a signature? One of a bundle of things. What constitutes an original document? One of a bundle of things. So it's quite a liberal regime. But do remember, if the importer is asking for documents, there's a reason why they're asking for them. The documents must be fit for purpose. And as long as the buyer knows what they're doing, when they open the LC, they will be asking for documents which they need for customs requirements, regulatory requirements, to give them the right to take delivery of the goods when the goods arrive, for example, a bill of lading, and if it's a CIP or CIF transaction, to prove the goods have been insured up to the correct level. So the goods presented, the buyer isn't just asking for them to be a nuisance, they're asking for them because they need those documents for a reason. Also remember, when the buyer opens the LC, and this will depend a lot on their standing with the bank, on their credit worthiness. But remember, if things are a bit bumpy with them and their bank, with their cash flow, then the bank may say to them, okay, we'll open the LC, but we want the money first. So, that's going to be detrimental for the buyer, because it means they're going to have to put the money down before the bank opens the letter of credit. And it's going to be a long time before you get the letter of credit, you ship the goods, they receive the goods. So, they're putting the money down quite a long time before they actually get value from the product. But that's a reality. If they're not credit worthy, that's a good reason why you would want a letter of credit. But it's always important to bear in mind, because that can be the start of a negotiation. The fact that they will have to put down the money early. And it's just something to keep at the back of your mind. When banks reject documents, there can be a lot of reasons for that. And I'm just going to give you some examples here, but there can be loads and loads of reasons why the banks reject documents. These are the reasons that come up more prolifically than any other reasons. So inconsistency, I spoke about that earlier, where you've got two documents presented and there's a difference in the information on the documents. One of the documents says the goods are UK origin, the other document says USA. Or one document says the goods weigh 5,000 kilos, the other document says the goods weigh 5,001 kilos. The bank won't just say, it's only 1 kilo different. They'll say they can't both be right. That's a discrepancy. Only one of those documents can be right. So the golden rule for the exporter is, before you present documents to the nominated bank, you check the documents against the letter of credit, but you also check the documents against each other for consistency. That's a really important thing to do. UCP 600 is very, very clear on what the signature block on transport documents should look like, whether it's an airway bill, a bill of lading, a charter bill of lading. UCP is very clear on that. Sometimes the documents are wrong. The exporter gets it wrong. Very often nowadays, LCs will give a time constraint for presentation of documents, and they will say something like documents to be presented within 10 days of shipment, or within 20 days, or within 3 days, or within 5 days. But generally, there will be a stipulation. If you present documents after the presentation time, then clearly that's going to be a discrepancy. If you don't present all the documents required, of course, that's going to be a discrepancy. If a document should be marked as original and it isn't, that's a discrepancy. If you try and present documents after the expiry date, of course, that's a discrepancy. When the LC's expired, it's dead. There's nothing else you can do with it at all. It's completely dead. So don't try and present documents after the expiry date, because there's no point in doing that. Some documents have to be endorsed. In other words, they have to be signed on the back. Easy to forget to do that. Normally it's going to be bills of lading or insurance documents. If you forget to do it and the LC calls for it, then clearly you won't get paid. If the description of the goods on the invoice is different to the description on the LC, that's a discrepancy. You won't get paid. Because remember, the description on the invoice is your legal proof you're selling the goods agreed in the contract. The description of the goods agreed in the contract will be transposed on the LC. So that description should be on the commercial invoice. If it's not, then that's going to be a discrepancy. If a document that you haven't generated yourself, like a shipping line bill of lading, if it's altered, the alteration must be authenticated. If it's not authenticated, that's a discrepancy. Late shipment, every letter of credit will give a latest date of shipment. If, for example, the LC says latest date of shipment 1st of October 2025 and the bill of lading is dated the 2nd of October 2025, that would be late shipment. That's going to be a discrepancy. So, there's no grey areas. The bank can't say, it's just a day late, we'll accept that. They're not allowed to do that. It's the rule of strict compliance. Okay, there's no grey area. There's no they can't say, well, it's just a little bit different what the LC is calling for. The bank isn't allowed to do that. The document is either compliant or it's not. That's all there is to it. So remember, the presentation must be the presentation to the nominated bank. The presentation must be complete, compliant, correct, and consistent. If the documents are not complete, compliant, correct, and consistent, they're discrepant, and then payment will not be made. So these are key things to remember. You present the documents to the nominated bank. If the documents are compliant, assuming you're the exporter in this example, you, the exporter, gets paid and the buyer gets the documents through the banking system, and therefore the buyer gets the goods. If the documents are discrepant, you don't get paid, but the buyer doesn't get the documents and they can't get the goods. And that protects the seller. So if the documents are discrepant, then the seller doesn't get paid, but they still own the goods. The goods are on the way to India by then, so they're going to have to get them back or find another buyer, but at least they've still got the goods. So that's the situation. So if the documents, you present documents to the nominated bank and they're discrepant, okay, the best thing to do is, if you can correct the mistakes, is get the documents back from the bank and correct them and represent them if you can do that before the LC expires. So the bank says to you, really sorry, there's an error in the document, and you look at it and say, oh, yeah, we can correct that. You would say to the bank, return the documents to us, we'll correct them, we'll represent them before expiry. So the exporter gets the documents back, they correct the mistakes, they represent, and they get paid. But not all things are correctable. Maybe it's late shipment. Maybe the LC says goods to be shipped by the 1st of October, bill of lading says 2nd of October. That would be late shipment. The exporter, there's nothing they can do. You can't correct that. So the next action will be the seller, the exporter, will say to the bank, okay, please get permission from the buyer to accept the discrepancies. And the nominated bank in the UK, in the example we had, will contact the bank in India and say, LC number 123456. Nominated bank, we have noted the following discrepancy. Please ask the opener, in other words, the buyer, if they will accept the discrepancy. So the issuing bank, the opening bank, will contact the buyer, the exporter's customer, and say to them, we have noted the following discrepancy, late shipment. LC stated goods to be shipped by 1st of October. Bill of lading has stated 2nd of October. Will you accept that discrepancy? If they accept it, the exporter gets paid and the buyer gets the documents and the goods. If they don't accept it, the exporter doesn't get paid, but the buyer doesn't get the goods. So the buyer's going to, they're going to want to know what the discrepancies are, and they'll look at the kind of things you can see on the screen at the moment. Is there discrepancy because the invoice suggests they're the wrong goods? Well, if the invoice is wrong, the goods description doesn't match the LC, the buyer may say, well, those are not the goods I've ordered, and they probably will not accept that discrepancy. If the letter of credit calls for a clean inspection certificate, saying the goods are of the ordered quality, but the inspection certificate issued by Intertek says the goods are substandard, they don't meet the specification of the contract of sale, then the buyer may not accept that. So, and also, if the discrepancy is that they haven't got the documents required for clearance, that means they can't take delivery of the goods. That means they're not going to accept that discrepancy. So a sensible buyer is going to have a close look at what the discrepancies are before they just say, yeah, we'll accept the discrepancy or we won't accept it. They'll look at what the discrepancies are and then they'll make a decision. If they don't accept the discrepancy, exporter doesn't get paid, but they can't get the goods. The exporter still owns the goods. And, in reality, most discrepancies are pretty small. They tend not to be major things. Maybe they're 1 day late in shipment, something like that. So if it's a small discrepancy, in most cases, the buyer will accept the discrepancies. So if there are discrepancies, there are various things the seller can do, but it's really just the first two that are the sensible things to do. Ideally, as I've mentioned, the seller should amend the documents, they should correct them and then represent them to the bank. If they can't do that, then through the banking system, they have to get the buyer's permission to accept the discrepancies and thus to authorize payment. So it's normally going to be one of those two things that's going to happen. Sometimes the nominated bank may say, OK, we've got your documents, they're discrepant, but don't worry, we will send the documents on collection to the bank in India. Never let them do that if you're the exporter. That simply means you lose the protection of the LC, and they're purely treating the transaction as a documentary collection. You've lost all protection of the letter of credit. Banks often say that with discrepancies. Don't let them do that. Always say, no, don't send it as a collection. Ask for the buyer's permission to accept the discrepancies. And again, the bottom bullet point there, it's fairly rare, but I put it there for the sake of completeness. In very, very unusual situations, for example, if the nominated bank coincidentally is the same bank as the seller holds their account, which would be a complete coincidence. But if it is the same bank, and that bank rejects the documents, they say the documents are discrepant, then the seller could say, well, what about if we issue you an indemnity in case you can't get repaid, will you pay us now? Now, that kind of indemnity is very, very rare. It's very unusual. I've purely put it there for the sake of completeness. But as I say, normally, if there are discrepancies, it's going to be one of the first 2 points there. Amend the documents and represent them, or get the buyer's permission to accept the discrepancies. What to do if things go wrong? You may have a dispute, you may present documents to a bank, and the bank isn't always right. Sometimes they get it wrong. So the bank says, we can't pay you because of discrepancies. You say to them, I don't think they are discrepancies. I think that you should be paying us. I've checked with UCP, I checked with ISBP, I don't think those are discrepancies. If you get into a dispute, you can use a solicitor, but better than that, you can go to the International Chamber of Commerce Court of Arbitration, and they will hear the case for you. And within the International Chamber of Commerce, they also have the DocDex rules, and those are specifically for letter of credit disputes. So in that kind of situation, you present documents, the nominated bank says, we can't pay you due to discrepancies. You say, we've checked with UCP, we don't believe they are discrepancies, you need to pay us. The bank says, we think they're discrepancies. Then you can make an agreement to get a DocDex ruling. You send the case to DocDex, ICC experts will look at it and they'll say, yep, the bank is right, that is a discrepancy. Or they'll say, no, the exporter is right, that's not a discrepancy, the bank must pay the exporter. And those are called the DocDex rules. It's a dispute resolution service. So those are letters of credit. There we go. And I haven't left as much time as I hoped to. It is quite an involved subject, but we've got a bit of time. So any questions or comments? Either about payments and letters of credit that we've spoken about today, or anything that we've spoken about in the 4 modules. Any questions at all?
Just if a letter of credit can't be honoured because, say, quality is off, is there normally a mechanism for a renegotiation, or would that have to go back to a sort of lose the letter of credit and some kind of direct agreement?
It would, yeah. So if you had a situation, for example, where the contract stated there's going to be pre-shipment inspection of the goods, and of course that will be on the letter of credit when it's opened. Goods subject to pre-shipment inspection, a clean report of inspection showing the goods are of ordered quality, grade, quantity must be presented. And the inspector inspects the goods and says they're not up to the right quality. I can't issue a clean report of inspection. It's going to be a non-negotiable or a qualified report of inspection. Then clearly that's not going to be acceptable to the bank. So before the goods are shipped, then probably what's going to happen is the exporter is going to get in touch with the importer and say, look, the goods are of slightly different specification. Will you accept the slight difference in the in the specification? And the buyer may say, they'll say yes or no. If they say no, we won't, then it may be that the exporter has got to completely, ship a nut. I mean, by that stage they won't have shipped the goods yet, so they may have to say, well, have we got goods which are the right quality, and then we'll get those inspected and we'll get a clean inspection certificate. Or quite rightly, as you say, there may be some negotiation. If I'm the buyer, I may say, okay, actually, I can see from I can see that the goods aren't of the right quality. It's not much different. I will accept that quality, but they may say to the exporter, of course, we want a rebate from you, or we want 20% off the next order, or something like that. So absolutely, it's likely to lead to some kind of negotiation. Does that answer that okay?
Yes, thank you.
Brilliant, thank you. Any questions or comments? So on today, or as I say, what we've covered previously in the 4 sessions.
Again, if you have any questions, and you are also welcome to put them in the chat, and I will pass them on. Thank you.
So as this is the last session, we need to see now if there's anything in the chat. Let's just have a quick look.
I think at the moment there isn't.
Nothing in there.
But if anybody wants to ask questions or explore scenarios where there is a problem with the contract, then this is your chance to ask them now.
I know, in the 4 sessions, there's a huge amount of information that we pass over. So what I always say to people is, don't worry about the detail. You'll get copies of the slides. The idea is to give you an overview of the 4 main elements of international trade transactions. Think back to day 1: commercial, transport, regulatory, and finance. Every transaction will have those four elements. And I hope, this has given you an overview to them. And, there's quite a lot more detail in the slides when you get copies of the slides. All of it is there. It is a lot of technical information. You're not expected to remember everything. Of course, you're not. But I think what you will find is, once you sit back a little bit and kind of, when you have a moment, have a look through the slides, and hopefully everything will fall into place for you. But anything else at all?
I think, John, this particular area is the case where a lot of disputes arise. They arise between the buyer and seller, they arise between the bank and the beneficiary. So I guess a question is, are there any recent cases that you can think of that might be interesting in this context?
I mean, there are
developments or in disputes.
On payments.
Yeah, on payments.
Oh, Helena, there are loads of them. At the moment, I think. I haven't got the. Currently, I'm doing expert witness on about 7 or 8 court cases concerning payments, where there have been disputes between banks, between exporters, sometimes between importers as well. There are loads of them, and I always find it frustrating. I mean, I do quite a lot of this work on behalf of clients in court cases, and honestly, it can be really frustrating because. And, this isn't me being unkind. This is a reality. If only the disputing parties read the rules. If only they knew they had the Incoterms book, they looked at the Incoterms. If they're getting paid by LLC, they have UCP 600. You could really avoid so many of the disputes. And I mean, there was a recent, in fact, last year I was in Singapore for a court case there. And, it was honestly, it was a dispute that should never have gone to court. It really shouldn't have done. It was a bank in Singapore that didn't pay the exporter under an LC. And the reason was the bank said that the bill of lading had a date of shipment which complied with the LC, but the bank said, we don't believe the ship sailed on that date. Now, the rules are very clear. The bank has no right to say that. If the bill of lading has a date, the bank has to accept that. If that date agrees with the LC says shipment no later than a date, and the date on the bill of lading is within the time period, the bank has to accept it. This bank didn't. They just said, we don't think the ship sailed on that date. It was, it was crazy. The rules are very clear about that. And I couldn't believe it. It went to court in Singapore. I couldn't believe they wanted a face-to-face hearing. So, and it all happened very quickly. So I had to rush out to Singapore for a court case which lasted about 5 minutes. And it was so straightforward. The two sides, the barristers, they read the case. And then the judge looked at me as the person giving, it's an awful term, but in most countries they call it expert witness. The judge looked at me and said, okay, the judges aren't experts on these things. And the judge said to me, are there any rules about these letter of credit things? And I said, yep, the rules are called UCP 600. And the judge said, is there a rule that can be applied in this particular case? And I said, yep, Article 5. And I had my UCP 600 with me. I gave it to the judge. He looked at Article 5 and, the case lasted about 4 minutes. He said to the bank, Article 5 is very, very clear. You have to accept the document as presented if it meets the requirement of the LC. And he just looked at the bank's barrister and he said, you must instruct the bank. They must pay the exporter today. They must pay the court charges. They must pay for the expert witness. And they must pay a fine as well for wasting the court's time. It cost the bank a fortune for something which was really clear in the rules. So that's just one example. But yeah, it happens over and over again. And when we talk about letters of credit, I always say to exporters is if a bank tells you documents are discrepant, never believe them until you've checked yourself. And the reason I say that is because there's a feeling if the bank says it, it must be right. But that isn't the case. Now, don't get me wrong. Most of the time banks are very professional and they know what they're doing. But it's estimated that 40% of the time with letters of credit, when the bank rejects documents, it's estimated that 40% of the time the bank is wrong, but the seller hasn't got the confidence to challenge the bank. The seller assumes the bank is right, when 40% of the time the bank is wrong. So, when I train companies in using letters of credit, most of the reason is to give them the confidence to challenge a bank if the bank says, okay, we've got the documents, but we can't pay you, there are discrepancies. And the exporter wrongs over because they don't know any different, whereas the bank may well be wrong. So yeah, it's prevalent. It really is a very big problem.
John, could you go over again that point that you made about modifying
Yes,
the Article 26 and the fact that the bank would not, is in the right not to accept it if it is modified. So can you just go over that again?
Yeah, definitely. So with every letter of credit, it will be subject to the rules. It will be subject to the USP 600 rules. But there may be things that it's impossible to comply with. So, for example, if you're talking about a big consignment of bulk goods, not containerized, but bulk goods, they may go on the deck of the ship. That's fairly normal. But the rules are very, very clear. If a bill of lading says shipped on deck, the bank will not accept that. That's a discrepancy. So if the transaction is such, the commodity is such, that it's very, very clear the goods may be shipped on deck, or they will be shipped on deck, then when the opener opens the letter of credit, they have to instruct the bank, the opening bank, to override Article 26. And they put a clause on the LC which will say something like, notwithstanding Article 26, we will accept a bill of lading stating the goods are being shipped on deck. Or, if it's covering something like steel, we will accept a bill of lading saying the goods have, having a clause on them. If it's not a clean bill of lading, if it's a clause bill of lading saying the steel is rusty, we will accept that because we know the steel is going to go rusty. So that's what's meant by express modification. If there's anything where the standard rules can't apply when the LC is opened, then the opener must make sure that the clauses, the articles of UCP are overridden so that the letter of credit can actually work.
Can a bank legally, retrospectively, not accept that modification if they have accepted it?
No, once they've accepted it, they can't go back on that.
Okay.
So once they've accepted that, that will be inherent in the letter of credit. Letters of credit are irrevocable. That's a really important word, irrevocable. So LCs are irrevocable. They can't be changed, cancelled or amended unless all parties agree. And that's why it's great that under the current rules, even if the letter of credit doesn't say it's irrevocable, it will be deemed to be irrevocable, and the bank can't just change something at a whim. Now, if they do decide that they don't want to honour that, then they could negotiate with the parties and say, we don't want to honour that. And if all parties agree, then they could remove it. But unless all parties agree, then it stays in the letter of credit. Dare I say it, it's very democratic.
Thank you, John.
I'm not sure that's the right word, but nevertheless.
Does anyone have any other questions? Okay, Dana.
Yeah, Dana, please. Oh, we can't hear you. You're on mute, I think.
Yes, sorry.
That's
I just want to say I'm new at this, as I think Paulina knows, but so it's so much detail. So I was very reassured that Jonathan said not to worry so much about the detail. And I think by osmosis, some of it is sinking in.
Yeah.
So thank you, Jonathan, and thank you for having this seminar. It was really perfect for me as a beginner with this. Thank you.
Oh, I'm so pleased. I mean, sorry, I interrupted, Paulina, but no, I'm so pleased. And don't worry about the detail. The detail is in the slides. You can refer to, what I do is I've tried to put together the slides so that in time you can refer back to them and it gives you the detail that you need. Don't worry about the detail. Diana, honestly, if you're walking away with an overview and you feel a little bit better informed than you were 2 weeks ago, then you should feel very achieved by that, and I would feel very happy with that. Absolutely.
Since I will also be providing the recording of yesterday's session and today, you can always rewatch it and
you can listen over and over again.
Especially if you have nothing else to do, right?
Yeah. What better way to spend your weekend?
Yeah. John, may I ask you a sweeping sort of question?
Yeah.
Just because I have observed it so often happening in our trade. Let's say a customer prepays for shipment and the shipment for supply, and it never turns up. Sometimes it is just the supply just, backtracks on the contract. Sometimes, perhaps prices rise in the interim and they backtrack on that for whatever reason, or their supply chain breaks down somewhere along the way, as happened, for example, in armed conflicts recently. Somebody ordered something from Russia and it can't arrive. So if the goods are not delivered, what avenues are open to the buyer in this situation? And I know there are multiple ones.
Yeah. Well, I mean, the first thing, it's this is the danger of paying in advance, and frankly, it's always so. When I train buyers specifically, I would always say to them, don't pay in advance, whatever you do. This is the danger. So what can they do about it? Well, the first thing, of course, is they'll negotiate with the seller and say, look, you haven't shipped the goods. We want our money back. That's the first thing. They could try. Otherwise, all they can do is go legal. That's all they can do. There's no other option. And that's really what the very big danger is, because bad things happen. Unfortunately, they do happen. Prices can crash. As you quite rightly say, there can be conflict. And, you have these logistic challenges that we seem to have had so many of them recently. The Red Sea closing, the Panama Canal running out of water, the ship, the Ever Given, blocking the Suez Canal. Things can go wrong. They can go wrong. And that's the really big danger for a buyer for paying in advance. So that's really all they can do. Hopefully the seller would be honourable and say, look, we haven't been able to ship, have the money back. Or otherwise, the only other way is by legal redress. That's the only other way to do it.
And whereby the MMTA would offer services like mediation and arbitration, so that people can settle their disputes without going to court.
Yeah, and that's
But
a good point, Pauline. And what I would always say is, the International Chamber of Commerce, for international trade, it's the ICC that have the best arbitration service. So you're absolutely right. And I always say to people, rather than going to a court of law, go to the ICC arbitration. It's going to be much quicker. It's going to be much cheaper. It's a bit like the case I mentioned a few minutes ago in Singapore. It was absolutely crazy it ever went to court. Then it was crazy. I can remember I said I'm quite happy to give documented advice on it. And the beneficiary said, no, it's going to be a face-to-face court case and we want you there. So I had 2 days to get myself together, to put the case together, to go to Singapore for a court case that lasted 3 minutes. And that would have been resolved by arbitration much quicker, much cheaper, much easier than having gone to a national court. So you're absolutely right. Arbitration is much better. And in international trade, the International Chamber of Commerce Court of Arbitration would be in most cases the right direction to go.
we have legal members within MMTA, how
Yeah.
lawyers and handle those disputes, and among other things, one of those big company called HFW, and they sometimes send out legal briefings.
Yeah.
And I would advise people to read them, although they're very sort of legally and technical. They do try to simplify them. And you have those cases which then create law. So, if a precedent is set, it might then be followed. So there are sometimes really interesting highlights from those trade disputes, and there are plenty.
Absolutely.
There are really a lot.
Absolutely. And I think, what I'd reiterate, just as a last thing, if I may, Paulina, is that, really, as I said right at the beginning last week, is that international trade is a rules-based system. And honestly, most disputes could be negated if the rules were widely known. And when I say the rules, I mean things like the rules of origin, the Incoterms, the UCP rules for letters of credit. If it's a bank collection, the URDG rules for collections or for guarantees. So, we do have a rules-based system. And for me, I always think it's a bit sad when it gets to a case where things do have to go to a court of law or they do have to go to arbitration, because normally you could actually roll back a little bit and look at the relevant rules-based system that we've got. And that would give the rule on the origin, on the contracting, on the payment. The rule is generally there without the need to go to arbitration. So, I think that's a really important thing. I think, international trade is rules-based, but I think the issue is the awareness of the rules globally. And, there are gaps, honestly, and that's where the issue lies, I think.
John, thank you very much. Just to check, do we have any other questions? If not, I just want to thank you, and also to remind everyone that we will be doing this training again, and also that we can provide training on specific issues. So if there are any components of this training or any other issues that you would like us to cover in a training, please let us know. I will be sending out a kind of feedback questionnaire, so you can let me know what aspects you would like to focus on and more details, but we could always add more granularity. So we would very much like to have John back and to give us, more training in more detail on the most thorny topics that people struggle with. So you could let us know now what you found particularly useful and what perhaps would be useful for you to train in more detail. And also you could let us know later as well, or if you'd like us to repeat this training for your colleagues.
And can I just say, Paulina, just my really grateful thanks to everyone for attending the training. I mean, it's, as I say, it's thrown a huge amount of information at you. So dare I say it, I hope you've enjoyed it, guys. I hope it's been enjoyable to some extent. I tried to make bits of it light where I've been able to do that, but I hope it's been useful. Thank you very much for your engagement. That's hugely important to me as a trainer. So thank you so much for your engagement. Thanks for listening to me and attending the sessions. Thanks to MMTA, Paulina, Freya, and the colleagues for putting it all together. Really grateful thanks to all of you, and good luck with your international trading, and hope to meet some of you again at some stage. So in the meantime, again, thank you very much indeed.
Thank you. So yes, please let us know.
Thank you, John.
Thank you.
Thanks, everyone.
All right. Thank you all, and have a lovely rest of the day. Bye.
Bye now.